In 1913, the Federal Reserve Act established the creation of what today is the most powerful financial institution in the world. A building located in Washington with a president who has turned into some kind of meme in recent years. The Federal Reserve stores the holy power of conducting, through their tools, the journey of the American economy and global markets. But did you know that from 1837 to 1863, there was no national banking authority in the United States? It's quite recent though the adoption of central banks across the globe. The first central bank as such appeared in the Netherlands when the Bank of Amsterdam became the first public bank to offer government deposits and loans while also acting as lender and clearinghouse for commerce and trade, playing a pivotal role in the increasing trade activity thanks to the expansion of the Dutch East India Company and funding Dutch investments and exploration trips in the new colonies. The success of the new institution in the Netherlands led to the creation of the famous Bank of Sweden, the Riksbank, which was indeed the first national central bank ever created, as the Bank of Amsterdam was managed by a council formed by city officials. The Bank of England followed and quickly became the most powerful financial institution on earth, banking on the success of the British Empire and achieving the landmark of holding the record for longest reserve currency upholder, until it was lost to the United States right after World War I, and the gap widened even further after the Allied triumph in World War II. To this day, the US dollar is the world's reserve currency, and the Federal Reserve Bank of the United States has monopolistic control over that currency, together with monetary policy in the United States. Today, it's widely known what central banks are and their role in the economy. But there was a period when capitalistic societies worked without a central authority, not only regulating the money supply, but also acting as a supervisor of banking practices. The role of a private bank is simple: engage in the business of finance by offering deposits to the general public and enterprises. Use the money from those deposits to invest and lend in the most profitable trades, bearing the lowest amount of risk, and share the profits with the shareholders by paying out dividends or stock buybacks. These banks today are regulated and supervised by the Central Monetary Authority. In the case of the United States, it's the Federal Reserve, and in Europe is the European Central Bank. In the States, the number of commercial banks have fallen to almost half of the amount operating back in 2000. During the last 2 decades, we went through the most devastating financial crisis on record back in 2008, and prolonged periods of low rates made the business of banking less profitable than before. Banks are today more regulated than ever, and the capital requirements they must hold have been strengthened through 4 Basel regulations, which aim at enhancing resilience and overcoming high levels of stress without putting the assets and clients of the bank at risk like in 2008. Economic crises are cyclical and inevitable. They have always been there, and we would be foolish to expect them to disappear in the future. But was the system better with less regulation and loosening conditions for establishing a bank than today? In 1797, 2 decades after the Declaration of Independence in the US, 24 was the number of chartered banks operating in the country. In 1837, after the signature of the Michigan Act, releasing banks from federal regulation and allowing each state of the union to handpick their preferred regulation for banking, the number rose to 712. The US government stored the wealth of the nation in some of these banks, but the gold, silver, and cash, denominated in US dollars, was mostly held in private vaults in federal buildings across the country, as the risk of many of these banks from failure was high and real. A difference between our current centralized monetary policy, with one independent institution not only supervising and enforcing regulation, but managing the money supply and settling interest rates, and the free banking period, was that the government had the power of issuing US dollars since the signature of the Coinage Act in 1792, and this would be the legal tender currency for the whole country, while the states could pick their preferred banking regulation and settle interest rates at their convenience. But with the Michigan Act of 1837, all private banks could also issue their own banknotes. Michigan was indeed the first state to introduce free banking, in their pursuit to bring the banking business as equal to any other industry as possible and make the financial markets more competitive and diverse. It would be unfair though to claim during this period there weren't any rules a bank should abide by. First of all, to start a bank, you need the minimum amount of capital. The quantity could differ from state to state. Many individuals wanting to start a bank but not holding enough capital would decide to sell shares to raise money and get started. Acknowledging this system is more risky to the client than a centralized one, states required banks to use that cash to buy state bonds, which would collateralize the bank enough to cover most of the depositors' money, in case there was a massive withdrawal of funds, decapitalizing the entity. With the state bonds as a safe cushion, banks could then start issuing their own notes. The system would work like this. One or more individuals collect capital and want to create a bank. They go to the state and buy bonds with some of that money. Now the bank has some of its capital in gold and silver and some in government bonds. Remember, this is not a centralized financial system, so banks can really issue their own banknotes, backed by the deposits of gold and silver in case customers want to exchange the notes, and buy state bonds based in US dollars if the bank's deposits suffer a run. Ultimately, those state bonds would be the insurance over the claims for the value of gold and silver stored inside the institution. The whole idea looks quite solid. Banking was experiencing unprecedented growth, with states having even every industry opening their own bank, and in places like New York, the boom of banking helped forge a financial reputation for the city still well recognized today. But there's certainly a reason most of you did not hear about this story before. Indeed, this story is about wildcats. We just mentioned every established bank was able to issue their own banknotes, with the only insurance of state bonds to protect the banknote holders in the event deposits of gold and silver were depleted. Unfortunately, this had serious flaws that in many cases led to bankruptcy of many financial institutions and the loss of confidence in a system without much stricter banking regulation. Wildcat banking was the term coined to tag some banks that were established with the only goal of failing, as there was an incentive to make money making use of a trading arbitrage at the expense of customers. The term comes after a bank in Michigan, issuer of banknotes with images of wildcats. They went broke after issuing tons of banknotes poorly backed by their capital reserves, hence it gave name to the practice of issuing notes with worthless or poor value based on the bank's reserves. The end of the free banking era came from many states losing up to 90% of the banking firms, as many used this wildcat practice to scam clients and steal the money from deposits. How? Remember those state bonds purchased to insure clients? Some states allowed banks to value them at par value, regardless of the moment of purchase. The wildcat banker would then purchase those bonds at market value, being way lower than par value. The wildcat banker would then start issuing an enormous amount of banknotes to clients and leave the city with their money straight away. The bank did not hold enough capital to reimburse banknote holders, and when state authorities started liquidating the failed bank, wildcat notes would redeem at a loss to the holder, in many cases not even having value at all. Although it's still today a matter of discussion which were the real reasons why the free banking era failed, the evolution of banks did not follow the same path in every state, with Michigan being a total failure and giving the wildcat a reputation in finance, and New York becoming a symbol of success in free banking, with a very low number of bank failures and an unprecedented growth in financial services helping the city to become the world's trade center. It was in 1863, with the approval of the National Bank Act, state banks lost their ability to issue house banknotes, and the US dollar became the only legal tender in the country. This marked the end of the free banking era, although banks were still somewhat free from regulation and supervision. It was not until the banking panic of 1907 the US government decided to create the Federal Reserve in 1913, finally ending the times of unsupervised banks and centralizing the monetary power in the country in just one institution. Free banking made the business of finance way more easy but also more dangerous. While some banks and communities thrived, others lost generational wealth to scammers and wildcat bankers. Many lessons can be learned from the free banking era, but eventually we should remember most of them, especially when others try to make us believe modern innovation is bringing something unseen and inexperienced, with what we supposedly will all be better off.